It's time for the Money Puzzle Podcast. With good conversations and realistic solutions to the money puzzles we all face every day. I'm your host, financial advisor, chartered financial consultant, and president of Edgen Insurance and Financial, Robert Edgen. Now let's get this show started. Hi there, hello, and welcome to the Money Puzzle Podcast. I am Robert Edgen, and I'll be your guide for the ride for the next few minutes. Each week, we look at a different piece of the money puzzle and practical ways to solve it so you can have the financial confidence you deserve and the future that you dream of. This is episode number 12, and today I've got my good friend and business partner from Denver, Brian Johnson, who came down to talk about investment terms that you probably have not heard or don't understand. Should be a fun conversation.
Yeah. I guess if you don't understand something, of course it'll be fun.
Well, you'll understand it by the time we're done.
You will, because we'll make it simple.
Simple. Common investment terms in our industry, but what is common to us is typically uncommon to folks who are not in the industry, because I have found a lot of people in our industry, we talk about BIPs and betas and alphas, but that's not how normal people talk.
No, they don't.
No.
And so we're just going to break it all down for you and make it as simple as possible.
That's right. I'm excited to get into that conversation today. But before we do, I always do a lot of reading and research when I'm preparing for these things, and I come across a lot of financial headlines that catch my eye. So I thought we would take a minute to look at some news. Today's article comes from Science Daily, and the headline reads, "Do witchcraft beliefs halt economic progress?" Brian, I'll ask you your opinion. Do you believe that witchcraft halts economic progress?
I do not know what they believe, but if they cast a spell, I don't know. You ever, what was that show on ABC with all the Disney characters from the old stories and they cast spells and all that stuff? I don't know, maybe.
Your kids are younger than mine. I don't know.
No.
All right. Well, let's find out what the experts say. You're obviously not a witchcraft expert.
An expert.
So, okay. So here's what they say. So first off, the first large-scale economic study to explore beliefs in witchcraft and the effects on local economies was conducted by American University economics professor Boris Gershman.
I thought that was back in the 1700s where they burnt everybody at the stakes.
We're still studying it.
Okay.
So, and for good reason. Listen to this. It's long been argued that witchcraft beliefs impede economic progress and disrupt social relations. Gershman's statistical analysis supports that theory. So why does witchcraft halt economic progress? According to the studies, in areas where witchcraft is prevalent, they found high levels of mistrust existing among people. They also found a negative relationship between witchcraft's beliefs and other metrics of social capital. Basically, they studied 19 countries in Africa and 23 other nations. So there's a lot of witchcraft still going on.
Of course.
And it comes down to this. There's a lack of trust among people and a fear that someone can cause a wealthy, or that wealthy people acquire their wealth through witchcraft. And so then if they call you out on it and you do not share your wealth, then they say that that proves that you are into witchcraft.
Why didn't he just study socialism?
So, well, witchcraft
It'd be the exact same
It is
thing.
not quite the same thing.
Oh, it is.
We're not burning socialists
Venezuela.
at the stake. So, all right.
Venezuela.
So here's what the study says. That you're scared. They're basically, it's all mistrust and fear, and it's halting economic progress, and it really does impede economic progress. They did have some good news. Witchcraft may be alone among supernatural beliefs for having a negative correlation to trust. Beliefs in heaven, hell, reincarnation, angels, miracles, and evil spirits don't change things. It's only witchcraft. So basically, if you don't want to impede your economic growth, stay out of witchcraft. I think that is the moral of the story. So, all right, that's the news for now. If you want to read that entire article, which is actually pretty interesting, I've got the link in the show notes. But for now, let's go ahead and get into the hot topic of the day. All right, so you want to do some investing and you go to meet with your advisor, or maybe you're watching some, Jim Cramer or other investment show on the old television, and they're throwing around words that sound pretty darn cool, but they make no sense to you. They're talking about alpha and beta and standard deviation, and you don't want to seem like you don't know what you're talking about, so you're like, oh yeah, I get it. You nod and shake your head, but secretly on the inside, you're like, what the hell are these dudes talking about?
Right, exactly. That's why we don't use those terms when we talk to our clients.
That's why we don't. But most industry people use a lot of industry jargon that only makes sense if you're in the industry. We think, or I think, that we have a special particular skill. We are really like financial translators. We speak all of the industry jargon, but we also speak English. So we're able to take that industry jargon and translate it for our clients.
Because when you think of alpha and you think of beta, guess what? It's Greek. It's a Greek letter.
I always think of alpha and omega, and I know it's totally different.
Biblical.
I know it's totally different, but so it's a confusing set of terms that we use. So we're going to go through 8 investment terms that you've probably heard of before or will hear if you get more into investing, so that when you're meeting with folks or listening to folks, you can have an idea of what they're talking about.
What you'll run into is if you do any of your own investing, you'll see it a lot.
Absolutely, especially if you do your own investing.
Yeah, you'll see it a lot, and so knowing these terms will make things a lot easier.
So, all right. So I thought we'd just go back and forth. Brian, why don't you start us off? Pick a term that you hear all the time, and give us the definition.
Well, one of them that you hear a lot of is alpha.
Okay.
And basically, alpha, which is one of the most difficult things to ever really achieve, is the fact that is how well is the particular investment, the particular stock, the particular mutual fund, whatever it is doing against a benchmark. So a positive alpha means it's beating the market. A negative alpha is the investment has not been beating the market. That's all it is. So if the benchmark is the S&P 500 as an example,
okay.
If the S&P 500 does 10 and your particular investment does 8, well, that's a negative 2 alpha.
So that's it. It's that simple.
That's that simple.
Okay, so that's alpha. All right,
alpha.
Thank you for that. How about if I go? You want me to do one?
Sure, yeah, you do one.
All right. I'm going to talk about basis points, or BIPs, as we like to call it.
Yep.
A basis point, really, we shorten it to BPS, but then we pronounce it BIPs. Basis points refers to a common unit of measurement for interest rates and other percentages in finance. 1 basis point is equal to 1/100th of 1%, or 0.001. And it's used to denote the percentage change in a financial instrument. So basically, basis points are often used in reference to fees or expenses that something's going to cost you. But it could also be used when you're talking about the growth of an investment. For example, if a certain investment has annual expenses of 1%, you'll hear it referred to as 100 bips, which equals 1%. If another investment has 50 bips higher of expenses, that really means it's costing 1.5%.
Right.
So every bip is 1/100th of 1%, but trying to say, hey, what are those fees? Oh, it's 4/100ths of 1%. It's a heck of a lot easier just to say it's 4 bips.
Yeah.
So it also helps you if you're looking at like 2 comparable investments and you're wondering, how do the fees compare? And you hear your advisor say, well, this one's 1.25 bips and this one's 1.75 bips. Really what they're saying is this one's 1.25%, the other one's 1.75%. But it's easier to say. Brian, give us the next one.
So another one that we often hear is beta. What's the beta of this particular mutual fund or the beta of this particular exchange traded fund? So all beta is a measure of volatility compared to the market. So if you have a beta of 1 as an example, then you have the same risk as the S&P 500. If the beta is 0.75, then we're a tad under, a quarter under the volatility or the risk of the S&P 500. So when you're looking at mutual funds, or you're looking at an ETF, beta is one of those things that we oftentimes look at. We want to see how risky the underlying investments are within the mutual fund or within the ETF compared to their benchmarks at the S&P 500.
So, okay.
It's a way to reduce risk.
Or a way to gauge risk.
Yeah, it's a way to gauge risk, and then to looking for the same type of return as say, the S&P 500 if that's the benchmark.
All right. So if you're trying to find out, or if your advisor says, hey, we can get a comparable return to the S&P 500, but it's only a 0.75 beta, or would you say a 75 beta?
0.75.
Then it's 25% safer than the market. So,
Yeah.
All right, pretty cool. Kind of going along with beta, let's talk about standard deviation. Yep. To me, standard deviation, I feel like I drew the short straw here, because this one to me it's a tough one to explain, but I feel like it goes along with beta. They say the standard deviation is a statistic that measures the dispersion of a data set relative to its mean and is calculated as the square root of the variance. It is calculated as the square root of a variance by determining the variation between each data point relative to the mean. If the data points are further from the mean, there is a higher deviation within the data set. Thus, the more spread out the data, the higher the standard deviation. Simple as that.
So it's simple. If you have a 10th grade student who's taking algebra, then you ask them, or they can figure it out.
I think if you're a physics professor, this makes it pretty simple.
Okay.
Let's try to simplify it a little bit more. In the investment world, the standard deviation is a measurement used for the amount of variability or volatility in a certain investment's return. So, for example, let's say you have two investments that you're comparing, and they both get 10% each year. One of them has a standard deviation of 5%. That means that you can expect the return to be somewhere between 5% and 15%, 5% above and 5% below that actual return. If you then have another investment, it still gets the same 10%, but it's got a 10% standard deviation, then you can expect the swings to be bigger. It would go from 10% below and 10% above. So it would go from 0% or 20%, right? So the higher the standard deviation, the bigger the swings you could see in your investment. So it could help you see which one might be safer if it's got a smaller standard deviation.
And so with that, then you also look at the beta as well, because that helps tell you the same type of thing. If you're, standard deviation, as Rob said, it can be kind of confusing. And so the one that has a 5% standard deviation is going to have a lower beta than the one that has a 10%.
It's also going to be able, if you're trying to predict where's my money going to be, right, and you've got a 5% standard deviation, well, it could be, gain 15 or gain 5, but it should be somewhere in between that range is what it gives you. But here's the other thing about standard deviation. One standard deviation is 68% accurate, or will come true 68% of the time. If you really want to get specific, you would use two standard deviations, which now instead of having a 5% spread, you just double it, right? Now you've got a 10% spread, but that gets you up to 95% of the time it will fall within that range. Okay, so that's standard deviation, just measuring the range that it goes up and down within your investments from the average that you're expecting. So, okay.
Yeah.
It sounds simpler when I describe it.
It is simpler when you describe it.
Okay, your turn. What do you got next?
ETF. It's an exchange-traded fund. Okay, so it's a fund that is traded on an exchange, the NASDAQ, as an example. So what happens, it trades like a stock, except an ETF can hold many different stocks or bonds or even real estate investment trusts within that ETF, but it gives you the ability to say in intraday of the market that you can actually trade it. Whereas the mutual fund side of things, which almost everybody knows what a mutual fund is, a mutual fund is not traded on an exchange anywhere. So it can only, if you place an order for a mutual fund, I want to buy $5,000 worth of XYZ mutual fund, then that order, you may place it at 10 o'clock in the morning, but the trade will not take place until the end of the business day.
Because it's not actively traded.
That's correct.
So, okay. Well, it seems fairly simple when you describe it like that. Dollar cost averaging. Okay. Actually, I love dollar cost averaging.
And we've talked about that before.
So, yeah. And so now we'll give the actual kind of definition description of it. Dollar cost averaging, according to Investopedia, is a strategy that allows an investor to buy the same dollar amount of an investment on regular intervals, and the purchase occurs regardless of the asset's price. So basically, dollar cost averaging allows you to average the costs over a long time period by investing the same dollar amount at the same time on a regular basis, so that over the course of 12 months or 24 months, you're actually averaging out those costs and buying more shares. So the easiest way to explain it is, let's say you're putting $100 a month into your IRA.
Right.
Okay. You do it on the 15th of every month, no matter if the stock markets are up or if the stock markets are down. Half the time, let's say the stock markets are up. So you're going to be buying less shares of things because it costs more.
Right.
And the other half of the time, if the stock market's down, you're still spending $100 a month, but you're buying more shares because the stocks are down. Right.
So in essence, over time, it actually reduces the cost per share.
That's right. It averages out that cost so that studies show you end up with more shares at the end of the year if you use dollar cost average. So basically, it's a great idea, and I love the strategy. If you're investing, pick a dollar amount, pick a date, and do it on the same amount, the same date every month. We should end up with more shares at the end of the year.
Well, if you look at the last few weeks, if you would have purchased shares, say 2 weeks ago when the market had been falling, you're purchasing it at a lower price than if you were purchasing it today.
That's right.
Because we've had three up days, and maybe we'll see what happens today. But it was up for a while. I don't know what it is right now. But if you purchase on the upside, you're just you're purchasing less shares for your dollar.
Yeah. Now, of course, by the time we watch this, the markets may be totally different. It might be down 5 days in a row or up 12 days in a row.
Knows?
This is just based on today. So so that was dollar cost averaging. All right, Brian, your turn. What do you got next?
Dividends. We're just going to keep it super simple. A dividend basically is you're just sharing in the profitability, the income of the company. So, pick any company out there that pays a dividend. Apple is an example. Okay. They over the quarter, or however they end up paying their dividends, over that particular quarter, they earned $25 billion.
Great quarter.
Great quarter.
Yeah.
They pay the dividend. So as a shareholder, you own part of Apple. Then for that income, they turn around and then pay you part of that income. We just call it a dividend.
Now, the way they pay it out is a certain amount per share. So sometimes you might hear, the dividend was increased by 22 cents per share.
Sure.
So if, let's take easy math. Let's say you own 1,000 shares and they're going to pay $1 dividend. They're going to pay $1 times 1,000 shares. You're going to get $1,000 in dividend payments, right?
Yeah. So the reason why it ends up being taxed for you too is because it is income. It's income for the company that turns around and is paid out to the shareholder and is considered income. If it's your Roth IRA, hey, great, you don't have to pay the taxes on that dividend. But if you're, in a brokerage account, like with my brokerage account, when I get a dividend in there at the end of the year in the tax year, I pay taxes.
You get a 1099 on it.
I do.
So that's right. Okay. Let's talk about my turn. I'm going to talk about Monte Carlo simulation. And
another fun one. You got all the hard ones.
Well, I agree, but I like Monte Carlo simulation because when I say it, I feel like I'm a spy. Or
in Monte Carlo, right?
or it's a psychological
What country is Monte Carlo in?
I thought Monte Carlo was. Listen, I'm not a geographist, okay, Brian. I don't know.
A geographist. I love it.
That's right. I'm not one of those. So the Monte Carlo simulation was actually named after the gaming and gambling that takes place in Monte Carlo. Because it turns out that a guy who worked on the Manhattan Project back in the day, he had to have brain surgery afterwards.
Oh, yeah.
When he was having brain surgery, he started loving solitaire. He was playing an immense amount of solitaire, and he wanted to predict when he would win a solitaire game. So he came up with the Monte Carlo simulation, but it's based on the fact that there are so many variables that have to be taken into consideration. So Monte Carlo simulation, let me actually talk about that here. It's used to model the probability of different outcomes in a process that cannot easily be predicted due to the intervention of random variables. So it's a technique that's used to understand the impact of risk and uncertainty when there's a lot of different variables. So let's explain it in English. It's also referred to as the multiple probability simulation. So in layman's terms, it just means that the variables are changed over over and over and over again, usually somewhere between 1,000 and 10,000 times in order to get a range of possible outcomes. Okay. So if you're not sure if your particular investment is going to earn 1%, 2%, lose 1%, lose 2%, a Monte Carlo simulation will just change that 1,000 or 5,000 or 10,000 times and then give you this range so you can predict I should be somewhere between here and here.
Sure.
Okay.
Yep.
It doesn't sound quite as cool.
It's not as sexy as standard deviation.
It still sounds just as cool. Monte Carlo simulation. I like that. So anyways, and then when an advisor is saying, we ran a Monte Carlo simulation, a computer does it. You can do it by hand, but who the heck is going to run 10,000 different variables? No, that's not me. And then they give you kind of the middle number because 50% will be higher, 50% will be lower. And they say this is probably where you will be based on the standard deviation.
Yeah, and just make it clear, it's not guaranteed.
Absolutely not.
Yeah,
no, it could still fall outside of that range, but
it just gives us kind of an idea of what to expect over a long period of time with the current behavior. So if you're investing $2,000 a month and you have a 20-year time horizon, over that time period, it gives us a range of where most likely you're going to end up.
That's right. It's a predictive tool.
Yep.
So, okay. All right. Do you have any left on yours? Did we do 8?
I don't know.
I have 2 bonus ones for you, Brian.
Okay.
Brian, can you tell me what is arithmophobia?
No.
No?
You're scared of math.
You're scared of math. You're scared of numbers. Arithmophobia is scared of numbers. So it turns out you actually are as smart as you look. I got one more for
Okay, one more.
How about scopophobia?
Being underneath a microscope like we are?
Actually, that's pretty darn close.
No, I don't know.
That's the fear of being recorded on camera. So,
okay.
Yeah, so obviously neither of us have scopophobia.
I was pretty close.
So you were. I'm going to give you credit for that.
All right, half mark.
You're pretty darn smart. So, all right, that's it for today's hot topic. I appreciate you joining me today. Brian and I will be back in 2 weeks to do it again. Next week, I'm flying solo, and I'm talking about side hustles. I started that conversation last week.
Side hustles.
Side hustles. So
you sound like somebody else on the radio.
Well, there's a lot of good things to say about side hustles.
Yeah.
So, all right. I hope that you enjoyed today's show. Do me a favor. If you did, if you got any value out of it, please share us with your friends and family. Go on to whatever podcast app you're listening to. Like us. Go to the website. Go find us on YouTube and like us there. We love reviews and we appreciate it. Also, if you've got a question about your own personal money puzzle, you can email us at questions@yourmoneypuzzle.com. Until next week, be safe, have fun, and go out and do something to improve your money puzzle. You'll be glad you did. And Brian, I'll see you in 2 weeks.
All right. Have a good one.
Registered representative of and securities offered through Securities Management and Research, Inc., SM&R. Member FINRA SIPC. Investment advisory services offered through BFC Planning, Inc. Edgen Insurance and Financial Services, Johnson Financial Services, SM&R, American National Family of Companies, and BFC Planning are independent entities. There are risks involved with investing which may include market fluctuation and possible loss of principal value. Particular investments may not be suitable for certain situations. Carefully consider the risks and possible consequences involved prior to making an investment decision. Our firm does not provide legal or tax advice. Be sure to consult with your own legal and tax advisors before taking any action that may have tax implications.